August was a tough month for growth assets, with the majority of major indices ending in negative territory. The last trading week of the month did see markets recover from the month lows, but not enough to claw back the lost ground. At the lowest point in August, global markets had lost $3 trillion in value, as gloomy Chinese economic data and surging US borrowing costs soured investor sentiment. Bond yields have risen in both the US and the UK in recent weeks, squeezing equity valuations. This has weighed on the technology sector, a sector which has driven the market for much of 2023. The so-called Magnificent Seven, Amazon, Apple, Microsoft, Meta, Nvidia, Tesla and Google parent Alphabet all suffered their first 3-week net losing streak this year. The eyes of the world turned to the Fed's annual economic forum in Jackson Hole, Wyoming. Fed Chair Jay Powell has warned that inflation remains too high, raising the prospect that the Fed was prepared to raise rates further if appropriate, and highlighting it intends to hold policy at restrictive levels until it is confident inflation is moving towards its targets. Headline US inflation, measured by the Consumer Price Index, was 3.2% for July, well down from its peak of 9.1%, but slightly ahead of the June rate. The Fed continues to keep maximum flexibility when it comes to policy actions moving forward. The central bank is now focused not only on the risk of tightening monetary policy too little and allowing inflation to become entrenched, but also raising rates too high. Doing too much could also do unnecessary harm to the economy. In the UK, growth assets followed a similar path to their global peers. The latest update from the Office of National Statistics put the CPI measure of inflation at 6.8% in July, down from 7.9% the previous month. While this is down from the 41-year high recorded in October, the figure remains painfully elevated. In terms of factor performance, small cap and value were the hardest hit, whilst quality eked out modest gains for the month. Turning to the defensive assets over the month, bond yields nudged towards 14-year highs, following the higher for longer central bank narrative. A stronger economy and the associated risk of a second wave of inflation means interest rates may well stay higher for longer, and markets are revising their expectations. In summary, the key challenge for markets as we go through the third quarter is to navigate through the data to finally see a peak in the current interest rate cycle. Until this is clearer, market volatility will remain. Therefore, as ever, retaining an appropriate level of diversification across asset classes, regions and styles remains key to avoiding potential pitfalls that could emerge at any point.